So in this lesson, we're going to be talking about indicators. In the previous couple lessons, I showed you how to install various indicators on your charts, such as the EMA, the 50 EMA, and MACD, and so on. In today's lesson, in this actual lesson, I'll show you exactly what those indicators are and how to actually use them. So we'll look at the 50 EMA, we'll look at the 20 EMA, we'll look at MACD, and a couple extra ones as well. So it's going to be a very good, very comprehensive lesson. I think you'll enjoy it. So let's have a look at the charts and I'll show you exactly what I'm talking about. Okay, so there's a few indicators I want to show you, such as the 50 EMA, MACD, and a couple others. We're going to start off with the 50 EMA. The 50 EMA is a moving average. It's an exponential moving average. So it's a 50 exponential moving average. And what that means is that it's a moving average that puts more weight and more significance on the most recent data points, okay? So the way that looks like, if we look at the charts right now, and we look at this monthly time frame on the top left, you'll see that we have the red line, which is the 50 EMA, and the blue line over here, which is the 20 EMA. And the 50 EMA, the red line, the way that these data points are calculated is based on the past 50 candles. Okay, so these obviously red and white candles, they're called candlesticks. So a 50 EMA pretty much takes the data based on the past 50 candles and then plots it as this moving average. Same thing with the 20 EMA. Takes the data based on the past 20 candles and then plots it as this moving average. So these moving averages, what they are at the end of the day, they act as support and resistance levels, mainly dynamic support and resistance levels. And what that means is that, again, there's static support and resistance levels, which we'll cover in the next lessons. But a dynamic support and resistance level is one that moves and it evolves with price action on a regular basis. So let's come back to the charts here. When we blow up this monthly time frame and zoom out a little bit, let's look at the significance of the 50 EMA as an example. So what I mean by support and resistance, a dynamic support and resistance, is that price action, these candles tend to reject these moving averages. So follow me along here. Price is falling down and then pull back, rejected right there. It rejected the 50 EMA and then fell to the downside. Then it broke the 50 EMA, continued higher. It was holding the 20 EMA over here, which is more of a short-term moving average, whereas the 50 EMA is a longer-term moving average. So then bounced off of it and then came back to reject the longer-term moving average, which is the 50 EMA right here. Okay, broke it over here, didn't reject it. And then again, another really good bounce of the 50 EMA, then a break and a retest, another good bounce of the 50 EMA, another bounce of the 50 EMA. And again, we have two other bounces of the 50 EMA here. So right away, you can see that when price action is trending, mainly when the price action is moving up and down all the time in a nice given trend, the 50 EMA tends to hold really good dynamic support and resistance. So when price pulls back to it, it tends to reject it and continue with the trend, or if it breaks it and then pulls back to it, it can continue in the new direction. So if we come back to the chart here, what I mean here is, again, right here during this recent time, we had the break and then the retest of the 50 EMA, and then the new bearish trend began, right? So that is why these EMAs are so important, because they act as support and resistance levels, which at the end of the day is very, very important when it comes to actually analyzing charts and figuring out where to enter and where to exit. Now, the 20 EMA is just a little bit different than the 50 EMA. It just means that it's more short term. So you can, if we zoom out even longer term here, we can see that when price is accelerating aggressively here on this time frame right there, it has small pullbacks to the 20 EMA. So when the trend is very strong, it tends to pull back to the 20 EMA. And when we need a deeper pullback, it tends to pull back to the 50 EMA. So that's kind of it for the EMAs at this point. One thing though, that as a tip I can give you when looking at both EMAs, the 20 and the 50, is these crosses, right? So we have one cross over here where the 20 EMA crosses the 50 EMA. What that cross means is that it's a potential trend change, right? So whenever you see that 20 EMA crossing the 50 EMA to the upside, or the 20 EMA crosses the 50 EMA to the downside, it could mean that the trend has now just reversed. It's not always true, but a lot of times it is. So if we look at this example over here, let's have a look at a couple crosses. So we have a 20 EMA cross the 50 EMA at this point, and obviously that started a brand new bearish trend. And then 20 EMA crossed the 50 EMA to the upside, and that started what we have here, a bullish trend, right? We had a very small kind of break, didn't last too long, went back up and continued with that bullish trend until again the 20 EMA crossed the 50 EMA. So we have this cross, and now again we're in a bearish trend. So those are the moving averages. They're pretty straightforward, and again, the 20 EMA and the 50 EMA are the ones that I use on a regular basis, but you can also use much more shorter ones, such as a 70 EMA, or even a larger one, such as a 200 EMA. A 200 EMA is a very long-term moving average, so it catches the long-term general trend, whereas the 70 EMA is a very short-term kind of style of trading. I like to focus in the middle range, so I mainly pay attention on the 20 EMA and the 50 EMA. Now, the next indicator that we're going to be looking at is MACD. So let's come back to the charts. And MACD is a moving average as well, but what it stands for is moving average convergence and divergence. So that's an interesting couple words over there. But if we look at the charts again, what we have here, so again, the blue line on the bottom is the moving average. It's the indicator that we already installed in the previous lessons. And what this means is that when this moving average is trending downwards or trending upwards, right, it's also trending and following price, right? So if we kind of follow along here, when this EMA or moving average right here, MACD, as it's trending downwards, right, making lower lows and lower highs, price action is also making lower lows and lower highs during the same period in time, right, which is right here. Same period in time, price action is making lower lows, lower highs. It's trending downwards, right? It's moving down, and MACD is also moving downwards. Now, so that is convergence. When MACD is following the price, that means that MACD is converging with the general price. Now, divergence is actually what I want to be focusing on, because when we have divergence, that means that it's a potential trend reversal, or at least it's coming at some point in the near future. Let's have a look at divergence here. So same indicator, we don't have to change anything. Divergence just means that price action is not, or MACD is not mimicking price action anymore. So if we find a really good example of divergence, that would be in the recent price action. So check this out. So if we look at the recent price, obviously we have been trending downwards, right? So we were up and MACD was also up, giving us a higher high. And on price action, we also have a higher high at the exact same time. You can kind of follow the cursor points right here, right? And as we made a higher high on the chart, you can also see that MACD also gave us a higher high. And then the bearish trend began. And as the bearish trend began, MACD is slanted downwards. So we are converging. We have a bearish trend and MACD is bearish. And at this point right here, we're also in a bearish trend, right? We're potentially forming a little bit of support, and we'll be focusing on support and resistance in the next lesson. But at this point, check it out. MACD is not following the trend anymore. MACD is actually giving us a potential higher high, whereas right here on price action, we actually have a lower low, or something that's called a double bottom, right? So that's divergence. What that means is that when MACD is not actually following price action, that means is that it means that it's diverging. It's doing the total opposite. If price action is giving me lower lows and lower highs, and MACD all of a sudden gives me a higher low or a higher high, that's divergence. And pretty much what that tells me is that at some point, okay, this is important terminology, at some point, price may turn around and start a new bearish trend to the upside. So if we look back to the charts, right here, at the same example, at some point, this could potentially break out and start a new bullish trend. And it will look something like that as an example, right? Because MACD is typically the first sign of a potential trend reversal. It happens early, right? When we get this divergence, a lot of times it happens early, and it means that at some point we may turn around, the price action may turn around, but it could last literally a month, it could last a week, it could last a day. It really depends on the time frame that you're looking at. This is a monthly chart. So this price action, for it to actually turn around, could take years, right? If we look at a smaller time frame, so if we come back to the charts and actually look at a daily chart, zoom in a little bit, we've had MACD divergence developing kind of right here. This isn't the best example of MACD divergence. The best one is actually right here. So check it out. Price is trending downwards. We have previous low, lower high, lower low, okay? And at the same time, as we made the two lows, MACD actually gave us a higher low. This is, again, divergence. It's not moving with price. At this point right here, check it out. It was converging. It was moving with price. Same thing right here. That is convergence, right? It's moving with price action. And as the price action made a lower low, this actually made a higher low, and that is divergence. And then we can see that the trend has actually potentially reversed short term, right? It's not a big reversal, but it actually went up, and that is MACD divergence. Now, the next indicator, and this is a bonus. I don't typically use this indicator a lot, so I'll just briefly talk about it. I'll show you how to install it in TradingView. And it's called pivots, pivot point standard. So if we look at the charts, come back to TradingView here. Again, same indicators here on TradingView. We have the 50 EMA and the 20 EMA. And we also have MACD, okay? So with MACD, with the pivot point standard, that's an interesting indicator. So if we install it here, go back to indicators and type in pivot point standard, you'll get this indicator that comes up. I'm just going to zoom out on this 5-minute chart, double click it, and I'll just show the historical points just as a reference for now. But this is what pivot points is. Pivot points is pretty much, it plots these support and resistance levels. Okay, so the blue line is the main pivot, the green line on the bottom is support 1, the green line on top is resistance 1. Okay, so blue line is pivot, bottom line is support number 1, upper line is support number 2, resistance number 2. Now I can also install support S2 and R2, as you guys see, S3, R3, which is support and resistance number 3, and support and resistance number 4, support and resistance number 5. I don't use those. They're not that significant as the initial one, which is just support and resistance number 1. Now I don't use this indicator personally because to me it's unnecessary, and I like to remove anything that's unnecessary. But a lot of times people like to use the pivots because whenever price is trending, it tends to reject one of these pivots. So in this case, it came to reject S1 and kind of started trending downwards. It held the pivot a little bit. You can see here it held S1 a little bit as support until it broke that level and continued to trend lower. So these levels, these pivots, act as support and resistance lines. Okay, we'll be focusing on support and resistance, horizontal support and resistance in the next lesson, but this is just another indicator that gives us support and resistance. The EMAs gave us dynamic support and resistance. These are just static support and resistance levels that change every single day. If we come back to the charts and double click on this, pretty much this is how you want to set it up. If you want to use it, if you want to play around with it a little bit, it's the type is a traditional pivot, and pivot point time frame, it's calculated on the daily price action, right? So it pretty much takes the daily high, the daily low, and the daily close price, and then averages out together, and it gives us the pivot points, right? So there's interesting calculations that go on in the back end. but then it plots the support and resistance levels based on the previous daily candlestick formation. So that's the pivot. I'm going to remove it from my chart because I don't use it on a regular basis, but it's something that you can use as an extra. To me, it's just unnecessary information. And the last indicator that I'll show you is RSI. RSI gives us, pretty much tells us when price action is overbought or oversold. So it's an interesting concept to explain. I'll have to show you on the chart, so I'll actually explain it. So let's come back. And right here, let's just make this 1 hour chart a little bit larger. Come back to the indicators and type in RSI. And the one that I want to focus is the stochastic RSI, the one over here. If you don't know what it means, you can obviously Google it. Everything is on Google nowadays, so you can Google the definition, read about it a little bit. But I want to give you the practical tools here. So when using RSI, personally, again, to me, it's unnecessary information, so I get rid of it, because later in this masterclass, I'll show you many other ways to analyze chart without actually using indicators. The only ones that we will be using is literally just the 50 EMA and MACD, and that's about it. Mainly the 50 EMA. That's the main indicator that I use, and I try to get rid of everything else that is unnecessary. And to me, RSI is one of those indicators, but it's a very popular one because it tells you when price is oversold or overbought. So if we look at the chart right here in the recent times, if we just make this indicator a little bit larger, there it is. What it tells us is that when we go above this 80 level and when we go below this 20 level, so when we go above 80, that means that price action is potentially overbought, right? And when we go below this 20 level, that means that price action is oversold, right? And at some point it has to reverse. And whenever it's up at the top above 80, that means that at some point it's going to reverse to the downside. And when it's below, it means that at some point it will reverse to the upside. But again, it's correct sometimes, but just like some indicators, I prefer to ignore it because it's not correct a lot of the times. So check it out. Right here, when we had this pullback, you can see that RSI went up, broke that 80.0 level, and at some point price action has reversed. This means that it was overbought, and then price action reversed, went down, then hit the lows, right? It was oversold, and then price action stalled and reversed a little bit. But you see how it just gives us this little movement? It doesn't necessarily mean that when we hit the lows here in RSI, let me just give my arrow. So when we hit the lows, it doesn't necessarily mean it's going to continue all the way to the upside, right? So this was right here when we look at price action, right? It hit this low, and RSI was telling us that it was oversold, but it didn't necessarily continue a lot to the upside. It was just a very small movement to the upside. And to me, this is why I don't really use RSI, because sometimes it predicts it really well. Other times it doesn't really do anything that's worthwhile for me to actually look at, right? It's not significant enough. That's kind of what I'm trying to say. And I rather prefer to actually dig into the actual price action itself without actually looking at the indicators. So personally, that's just an indicator that you can play around with, see if you like it, and mainly focus on the levels above 80 and below 20, because that means that its price action is overbought and oversold. And then play around with it a little bit, move around on the charts and see how it reacts. See when price action turns around. When it hits those tops, typically we have a turnaround, or when it hits those bottoms, typically we move to the upside. So have a look at it. But again, you can see here in the recent times that it's not that significant. RSI is moving up and down all the time, breaking the 20 and breaking the 80 level to the upside. But I mean, we're still in a very big bearish trend here on a 1 hour time frame, and RSI just gives us indicates these small little pullbacks in price, and that is not significant enough for me, hence why I don't use it. One more indicator that I use on a regular basis is volume. We installed it in the previous lesson on the 5-minute time frame. So we're going to have a look at it here just for a few seconds because it's a very simple indicator. So let's have a look at the charts. And volume pretty much tells us that there's a lot of action. There's a lot of volatility happening right now, this moment, right? I have volume on a 5-minute time frame. So whenever I get a spike in volume, that means something's happening. There could be a news announcement that just dropped and everybody's reacting to it. When volume spikes, that means that people are buying or they're selling. And there's a lot of buying and selling when we have a big volume spike. So if we look at the 5-minute chart here and we zoom out, on this 5-minute chart, I'll make it bigger. There it is. You'll notice that volume goes from low to high to low to high every single day, right? Every single day we have periods of low volume and periods of high volume. We mainly want to be trading around the periods of high volume. We want to be trading when everybody else is trading, right? When there's action, when there's momentum, right? And preferably we just want to enter just before the volume kicks in, right? So if we look at here, this is an Aussie dollar pair. So the volume starts to, because it's an Australian pair, the volume already starts to begin during the Asian session. So pretty much when all the Asian time frame comes to work, right? Everybody who lives in the Asian time frame comes to work, starts jumping on the computer, the banks are working, government is working, news announcements are being released, people are trading, and that's when volume starts to pick up because they're in the Asian time zone. Same thing for European countries, such as the London time zone, right? Typically for a pair such as euro dollar, over here, we typically have the major spike in volume sometime around 6 a.m. GMT, which is just the beginning of the London trading session, just the beginning of the London work time, right? When people literally arrive at work and the banks start working and so on. So that's when we initially get the big spike in volume for European pairs. Now for North American pairs such as dollar CAD, that is the initial major spike in volume typically happens when the New York session opens up. So when the New York Stock Exchange opens up, when the New York banks, North American banks open up specifically on the Eastern time zone. That's when the volume spikes. So that's when we typically want to be around the charts to make sure that we are catching those opportunities if there are any. So that is it for the indicator lessons, right? The main ones that I want you guys to be focusing on are the moving averages, such as the 50 EMA and the 20 EMA. And MACD is another interesting one, but know that MACD is a little bit delayed. 50 EMA, when price action is rejecting it, that's instant. You know, we want to be focusing on that indicator right then and now when price action is actually rejecting it. MACD is a little bit delayed. So when we start seeing MACD divergence, that means at some point price might turn around. And then volume is the last kind of indicator that I want you guys to focus on. That pretty much means that when we get a spike in volume, that's when action is happening. That's when people are in the market and they're ready to buy and sell. When there's a big spike in volume, it means that there's probably a news announcement that was just released. The government said something, or the prime minister or the president just made an announcement. Or if you're trading the stock market and volume spikes, maybe we had a news release that was related to the actual company itself, and therefore people are reacting to that news release and volume spikes to the upside. So those are the main indicators: EMA, MACD, and volume. I hope you guys enjoyed this lesson, and I'll see you in the next one.